Okay, I think we're about ready to kick off here. Just a reminder, as you're entering, please make sure you mute yourself if you aren't muted already, just so we can cut down on background noise. And all right, let's talk interest rates. So I just want to say hello and welcome everyone. This is our August Enhance Webinar. I'm Amanda Borkowski. I am the DGN staff lead for these webinars, and I'm just going to start with a couple of updates and some introductions, and we'll get going. So today we are joined by Ashley Arrington to talk interest rates. We are really excited that you're here and that you can join in on this conversation. That's very timely, and we encourage you to do that. So I would recommend please use the chat feature if you have any questions come up as Ashley is presenting. And at the end, we will also have time for you to unmute and ask, or use the chat even more and ask more questions one-on-one with Ashley. So as always on these, we love being able to see you during these webinars, and our speakers appreciate it too. So if you are able, I welcome you to turn your video on, come as you are. If you're eating lunch, if you're in the barn or you're in the office, we'd love to see you. And then I just have a DGN announcement before we get going. So somehow World Dairy Expo is coming up quick, and we are once again going to have a presence there. And I really hope that I'll be able to see you join us at one of our events. We have 3 different activities going on, and this is a really big year for Dairy Girl Network because we are celebrating our 10th anniversary. DGN has been around for 10 years. We've experienced a lot of growth, and we really want to celebrate that with you. We will be opening registration and giving out more information next week. So make sure you're on our email list or you're following our social to hear more about that. But I do want to give you a couple of sneak peeks now. So first of all, once again, we will be hosting a family lounge in Exhibition Hall. This is a quiet and clean space for new moms and families with young children to rest and relax and recharge from the hustle and bustle of Expo. There will be a changing station. There's comfortable pumping and breastfeeding areas, snacks, toys, and really just a quiet space to take a breath. So be sure to check that out on the 2nd floor of Exhibition Hall. We will also have our annual Connect networking event on the evening of Wednesday, October 4th. This event brings together hundreds of women for camaraderie and personal and professional development and networking. And we're definitely going to have a couple of fun new pieces to celebrate our anniversary. So I hope to see you there, and I hope you can come celebrate with us at that event. And new this year, and very exciting, we are co-hosting a Tan Bark Talk on Friday morning, October 6th. Join us for this free event that's open to all, where we're going to bring together some big names for a panel discussion on women leading dairy challenges and opportunities. Again, stay tuned for information about all 3 of those activities coming out next week as we open registration and launch some of those details. And now, the moment we've been waiting for, I am going to introduce today's speaker. So Ashley Arrington grew up in Georgia, surrounded by everything agriculture. She graduated with a bachelor's degree in finance, then obtained her master's of business administration degree. She worked in the banking industry for 15 plus years, where she concentrated exclusively on agricultural banking, financial analysis, and debt analysis / placement. She was the founder of Agri Authority, a consulting company focused on the financial side of agriculture. And now Ashley is the director of real estate lending for Ag Resource Management. She also teaches banking and financial concepts and works as a public speaker with appearances at various seminars and conferences. So remember to please use that chat feature and engage with the conversation and ask questions throughout today's webinar, or wait till the end to unmute yourself and ask questions then. I do want to give a really big thank you to ARM, Ag Resource Management, for sponsoring today's webinar, and another thank you to Zoetis for providing our web hosting and recording for all of our enhanced webinars. All right, Ashley, the floor is yours.
Okay, thank you for the introduction, Amanda. So I'm really happy to be here. Amanda had originally reached out to me in about the second week of March to do this, when it would have been a little, it would have been better to probably had it in March. But that was a week before I went on maternity leave. So I just got back from maternity leave. My husband actually has the baby in the room right there. So if y'all hear crying, just disregard it. He'll have him calm down in just a moment. But yeah, so I'm happy that they, Dairy Girl Network, decided to still go ahead with everything and invite me to come back once I come back from maternity leave. So I'm happy to be here, a little overdue from the maternity leave and everything, but happy to be here now. So let's get started talking about interest rates. So, in talking about just interest rates in general, I usually try when I'm speaking about something to talk about the topic, why we need to talk about it. But I think that's kind of, out the window now. That horse is already out the barn. We already know why we need to talk about interest rates. I mean, it has been a hot topic for a while now. So what I really want to focus on is how we can be proactive. And before we can really talk about how we can be proactive today, and when talking about being proactive, not just in our business, but our personal lives as well. Because anytime you're going to run into borrowing money, it's going to impact that. It's going to impact credit cards. It's going to impact purchasing a car, a farmland, a house. All of that is touched by interest rates. So, how can we be proactive? And before we can talk about really how we can be proactive, I think it's important to see what the past has taught us. I've done multiple, before I went on maternity leave, I did multiple podcasts, interviews, things when rates started going up. It was a hot topic. Get Ashley on to talk about interest rates. And one of the number one questions I always got was, is this the 80s again? Are we going to see the 80s? And we'll address that as we go further. I won't give a spoiler alert, but we're going to talk about that. But it is important to look back at the past. So we're going to address the 80s, of course, the hot one to discuss, but we're also going to talk about the upward rate cycle of the early 2000s. A lot of people don't really talk about that one, or kind of forget that one happened, but it was kind of similar, not extremely similar, but it's closer to what we're seeing than the 80s were. We're going to take a look at that one, and then take a look at where we are today from the beginning of the rate rise in 2017 up until now. So we're going to see, is there a pattern to how many years it takes for rates to come back down? And you'll see come back down, quotes on there and air quotes from me, because, come back down to what? Is it supposed to come back down? Just kind of a general chat around that. Are the same economic factors driving every upward rate cycle? So of the 3 rate cycles that we're going to discuss, or are the same factors driving each one, and in what capacity? Are current rate hikes giving relief from inflation? I have a real life example of that I'm going to go through as we go through here about inflation, how it's affected me and how I've seen it change. Have past rate hikes solved inflation issues? So when we saw rates start to go upward in the 80s as well as the 2000s, and those inflationary issues, did that fix it? And is there any correlation across these upward rate cycles? So that's what we're going to get into. So let's see. First thing, prime rate in the 80s, the hot topic. What a time to be alive. That was quite the roller coaster. As you see, okay, so as you can see my mouse moving around there, from 1980 to 1983. Here, oh my goodness, to ride out an adjustable rate mortgage in that time period, bless you, you are a real one if you did that. Good Lord. That was a heck of a ride right there. The peak of the decade, as you see right here, was 21% in 1981. The lowest point was 7.5. So, I mean, that's 13.5 point spread right there that you're talking about across a decade. So is that really comparable to what we're seeing right now? Not yet. And I hope we don't get there, but that's quite the spread right there. And we ended the decade at 10.5%. And I would like to pay special attention right here to this average, because we're going to talk about the average for each of these decades. So the average across this decade, which spanned from, these charts go, you can't see it, but they go from January to January of each decade. It's just the way the chart is, that it shows just February at the bottom. But over the course of that 10-year period, what it is after every rate hike, I just put it all in Excel and did the average function. And it's 14.3 is what you're seeing there. So here we go. So that is the 80s. Is that similar to what we're seeing right now? Remember what this looks like? Well, you don't have to remember because I'll scroll back and look, but that is what the 80s look like. So just try to remember this little area right here as it relates to right now as we move forward. What were the drivers of rates in the 80s? Did interest rates hikes fix the problem? So in January of 1980, inflation was 13.91%. In December of 1989, so the last month of that decade, inflation was 4.65. So was interest rates the only thing that helped inflation calm down? Maybe not, but you see how inflation was correlating to those rates. You see the 1980, so 1983, that big area that we just saw right here. And in this time period right here, where you saw this straight upward trajectory, this is when inflation was 13.91%. And then when rates hit 21%, this is when inflation started to come back down. So I would say that it was one of the factors behind inflation. One real world story, no spoiler alerts for going into the upcoming charts. Lord, the word chart left my mind for a moment. That's mom brain for you. Charts that we have coming up is, what we're looking at now. You saw inflation. A lot of people like talk about in the grocery store. The housing market. The housing market got super hot. Everyone decided right after COVID that they needed a new house or they wanted to add on to their house. I guess everyone being in their houses so long during COVID, they're like, I'm going to live here. I might as well make it look like or do whatever I want to with it. And materials for homes went through the roof. Well, that was a real world thing that happened to us. We actually decided and started looking at adding on to our home in December of 2019. What happened in December of 2019? COVID got introduced to the world. So we are just now we just got started a few months ago because we were waiting on materials to come back down because they hit all-time highs. Lumber was up like 300%. And I'm like, we can wait. I don't need it that bad. But now they're back. Are they back down to the levels that they were pre-COVID? No, they're not. But they're way lower than they were. And a product of that is the housing market has cooled off. Well, what's one of the reasons the housing market has cooled off? Interest rates. You could get rates below prime, rates below 3.25 through the period of stagnation where we had 3.25 for an extended period of time. That's no longer the case. So buying new homes, adding on to homes, all those things have calmed down a lot, which has now in return calmed down the materials market. Thank goodness. So Ashley can finally add on to her house for her new baby. Next, unemployment was another driver. Unemployment was 6.3% in January of 1980. Unemployment was 5.4%. So not as drastic of a difference in unemployment as it did in inflation, but it had calmed down somewhat. Prime rate in the 2000s. This is one that I hadn't had anyone, rates first started going up. Even I remember being at a conference at the beginning of 2018 because there was a rate hike in 2017. And when we first started coming up off of that long period of 3.25 and no one even asked the question or even thought about this, it's like everyone forgot that rates hit 9.5% in the 2000s. We're not even at 9.5% now where we are, but we were at 9.5% in the 2000s, but no one really likes to talk about it. It doesn't really get brought up as much. It's always interest rates. Automatically, when you think historically, your mind goes straight to the 80s. But this one is actually more akin to what we're looking at now. So what you're looking at right here is, versus what we saw in the 80s where we had the steep climb up. This one is showing a trajectory downward and then back up. So what was happening right here, this is the end of the dot-com bubble. I don't know if anyone's old enough to remember that. I was a wee child, but that was something that going into the late 90s, early 2000s was the dot-com bubble bust. And with that is what sparked these interest rates to start to trend downward. And they stayed down for several years here from about 02 to 05. And then they started moving upward as the economy started to boom more. The peak of the decade was at 9.5 coming off that dot-com bubble. We ended though at 3.25. And this chart, and I think it's because I have everybody's pretty faces up here. Let me move this over because I can't see the other side of my chart. I'm just gonna move this over here. Okay, sorry about that. So what we have here at the other end of this chart is you'll see 2008. What happened in 2008? The 08 financial crisis. So this decade is one that is actually very worth talking about and more noteworthy, I think, than others as it relates to interest rates, because this decade was bookended by two events, bubbles, catastrophic events, whatever you'd like to call them, the dot-com bubble at the beginning, and then the financial crisis at the other end. So you saw the high, you started on the high, came down, started to go back up as we saw some economic progress, and then ended on a low. So after this happened here, we will remain at 3.25% for 9 years, which is a product of the financial crisis mainly, but also some tie back to all the way back to the dot-com bubble, because we had these two events bookending this decade right here. So it's before we start raising interest rates again, it was kind of what has the past taught us before we start moving back upwards. And we've had such a financial crisis here. 2008 was absolutely terrible. It changed regulations in banks. It changed regulations, just how you purchase a house changed drastically, just borrowing money in general. And we saw all the big banks fail, all the big bailouts, all those type things happened. So it stayed at 3.25 for 9 years. You're not going to see a chart from me next showing you 2008 to 2017 because it's a flat line. It looks just like this. So that's not a very interesting chart. So it's not in here because it's just flat. There's a period of stagnation there almost for a decade. And that's not normal. It's not normal. What's normal is to have something that looks like this and something that looks like the 80s. Historically, this is not a normal chart. Really, anything that moves or can be moved or changed, usually looks like this. It goes up and down. There are peaks and there are valleys. You don't have many times that anything that's chart worthy is just a straight line. So really, I like to tell a lot of my younger farmers that I work with, especially those that are probably in their 30s, that they're spoiled. I'm in the same category as them, but they're spoiled because all they ever knew when they started borrowing money was 3.25%. That's what prime was. So if you started farming anytime from 08 till 2017, that decade is when you started farming, all you ever knew was historically low rates. And you heard the words, you probably are sick of hearing unprecedented times as it relates to COVID, right? Everybody says we're in unprecedented times, we're in uncharted territory. Well, for 9 years, all you heard, and I know everybody got tired of hearing it, was historically low rates. A lot of banks hung their hat on that. Lenders would advertise that historically low rates, come refinance 30 years, lock your rate, all those type things, because it was abnormal to have the chart look like a flat line like this, straight across. So the average of this time period here, where you're starting at 9.5, which we're not at yet, but we're only 100 basis points off of, and end all the way at 3.25 is 6.38 for that decade, which really isn't that bad when you think about it. But I want you to remember that number. I'll scroll back to it, of course, but I want you to remember that number as we start to go forward into where we are today. So now that we've talked about two different rate cycles, let's think through some of those takeaways before we start talking about today and how we can move forward and be proactive starting today. Upward rate cycles are usually not just a year or two. Historically, they take years to resolve. So let's scroll back real quick. This right here, these, if you take a look at these are years, as you see this. This took from 9.5 to go down. And also, we all know what happened, there was terrorist attack right here. So that was part of this downward one too. And once again, there was catastrophic events all through this decade here. But This took 2 years to go to come down. And then for it to have this trajectory upward, you know, this is across 9 years. Then we go back to 1980, there's constant movement in this chart here that you see. Up and down, all around. You don't see any stagnation here. It takes time to resolve that. So we were all the way up to 21%. We ended the decade on 10.5%, but it took 10 years to come down 10%, if that makes sense, going across there. So it's usually not a quick fix unless, going back once again to the 2000s, there's a catastrophic event. So that was my next bullet point. Unless there's a bubble or a catastrophic event. If anything, the 2000s upward rate cycle taught us was bubbles pop, catastrophic events happen, that impacts rates. Terrorist attack, dot-com bubble, financial crisis. That made quick movements happen all of a sudden. So you saw it coming up on the chart, and then you saw it go straight down. Then you saw it come up a little bit and then go straight back down, versus 1980s where it was just up, down, up, down, up, down, up, down, because that was just, they were trying to figure it out. They were trying to resolve inflation. 2000 was riddled with catastrophic events and bubbles. So as we'll see in the upcoming one, and I've talked about a little bit with my example of adding on to my house in the housing market, the event of COVID itself beginning in 2019, you'll see this on the upcoming chart when we start talking about present day, it killed the 2017 to 2019 climb upwards. And COVID, the bubble, you know, there was so much money pumped into the economy by the government when everything was shut down, the PPP loans, the EIDL loans, all those type things, is what led to the current climb in interest rates. So once again, we have catastrophic events, we have bubbles, is what we see on charts. Anytime you see a steep trajectory upwards or downwards, you can go back and Google it, or however you want to research it and figure out what the catastrophic event or the bubble was that popped during that year. So what next? Looking at past charts, the steep trajectory upward leads many to believe a correction will occur more quickly. However, as we've just been chatting about, history tells us a quick fix is not a fun one. There's usually a bubble popping or a catastrophe. So chances are, what I'm saying here, chances are the Fed's not going to meet and say, okay, we figured out inflation, rates are going from 8.5, we're just going to slash them back down to 5 today. That's not going to happen. The only way that we move down quickly is something bad has to happen economically, if history serves us correctly. So we could see a quick fix to what's going on, and they could, as you remember the air quotes in the beginning, come back down, but it would take something not that fun that could impact a lot of people negatively if we're looking back to history on what has happened. So now let's take a look at prime rate 2017 to present. So we're coming off of, as you see at the beginning of the chart here, and you know, the chart in the middle, I didn't even put in here because it's not a fun chart. It's a straight line. It literally goes here, straight across, no fun, straight line. We're coming off of that right here. You see the beginning of it from there. And then in 2017, we start this climb upwards off that stagnation, that period that got everybody spoiled rotten because all they ever knew was 3.25% rates. The current peak is present day. And you see this climb over here. That is the steepest climb there is. Even if we go all the way back real quick to the 80s, this climb that you see right here, if you compare it, they look similar. But I promise you, we've done the math. And this slope here, you'd fall off. If it was a roller coaster, you'd fall off. You're not going to make it. It's straight upwards. You'd fall backwards off of it. So once again, the fun term of unprecedented times as it relates to rates comes into play because it is a steep trajectory upwards. The first increase that you saw was in the economic boom. Some people tie that to, you know, the economy really starting to get going in 2016, and then which led to a increase up to 5.25 But then this line that literally goes straight downwards, that's COVID. That's when COVID happened. As I told you, I decided that I wanted to add onto my house in December of 2019. That was a great decision, actually, because there's COVID right there. Boom. That didn't get to happen. So 2021, that's when you start to see this increase. And the writing was on the wall. We knew what was going to have to happen because inflation just started to get crazy. There was logistical issues that was related to COVID because people were sheltering in place, whatever you'd like to call it. There's a lot of different terminology for that. The over the road truckers, I think there were strikes associated with that. Materials were not getting shipped in. We were not really receiving them from other countries since it was a worldwide pandemic. So the prices of everything were ridiculous. Cars, oh my gosh, I bought a car right before COVID happened, thank goodness. But before that, you could make a deal on a car. You could call and negotiate. That was part of the fun of buying a car was, going back and forth, all that. None of that no more. It's, you have to special order it now. They still now have not caught up with it. There still are not as many cars on the lot, and they still have not met up with the demand. So that is what's driving inflation still today. Now, do we remember what those averages were that I was talking about? So 14.31 was the average for the 80s. 6.38 was the average for the 2000s. It's 4.78 for this decade so far. For us to get up above those other decades, there's going to be some more increases because we still had this period where we were spoiled in here, This is coming off there. We're still at 3.25 here. We only got up to 5.25 here. We dropped off and then stayed down. So this steep trajectory upward is so steep because, of course, it's going upward so quickly over a short period of time. As this chart spreads out, if we continue to go upwards, of course, its average will increase. But as of right now, historically looking back, we're not in that bad of a place. We're not even to where we were in the 2000s, up to 9.5%. Am I saying that interest rates aren't bad right now and it doesn't seem expensive and it's not impacting people? Absolutely not. Interest rates are impacting people. It's impacting balance sheets. It is impacting P&Ls. You see interest expense. We're going to get into that in a second. People blowing those out on their expenses, line items of their budgets. But if we take a look historically, I try to tell people that, when they get all excited or upset about it, historically, it's not that bad yet. We've seen worse, and we have fought worse as it relates to the level of inflation that we have. And these rate hikes are helping with inflation somewhat. Have they done everything they needed to? And is inflation back in, had completely pulled its reins back in? No. But we have seen, as I discussed in the housing market, things have started to come back down in certain sectors, but it takes other sectors longer to catch up. It depends on what the issues were that were impacting those. What are the current drivers of rates for the period that we're talking about now, 2017 to present, taking into account when the first increase happened? Inflation, of course. The jobs market. How many times we've had multiple restaurants around here closed because they couldn't find help. That's one of the biggest things everyone talks about is trying to find help, trying to hire people, all of that. The jobs market is another big driver. The COVID bubble, for lack of better terminology, still the logistical issues that plague us years after COVID is over with. Still trying to get things in stock. In some areas, it's kind of the new normal, right? We may never go back down to where we were before in terms of prices of some items. What was similar to past cycles? So there was inflation in the 1980s and the 2000s. We saw that. There was job market issues in the 80s and the 2000s. We saw that. There was the COVID bubble for present day chart, the .com and housing bubble of the 2000s chart, as well as a terroristic event. So are the drivers similar? Yes, by name, they're similar. Inflation, jobs market. Catastrophic event. But the weight of each is different, and the world economics of it is different. What led into the 2008 financial crisis was not something that was near as widespread as COVID was. COVID was a worldwide pandemic that impacted our economy, but also the worldwide economy. So you can't really compare those two as well. And then the 80s. So looking back to the 80s, there was a lot of predatory lending practices. There was a lot of regulations that are now in place as it relates to lending, banking, and other areas of the economy that were not in place back then. So to compare now in the economic environment and the way that banking's done, interest rates, things like that are done, you can't really compare it to that either. So there are some similarities in terms of when we see upward rate cycles, we almost always see inflation. We always usually see a job issue. And if we see a quick correction that gets everyone's attention, it's always going to be a catastrophic event or a bubble. But the type of things related to those, what drove the inflation initially, what drove the job market changes, and what the catastrophic event was, is different across all of them. So we can learn and take a look at it in terms of how long it takes to correct, what a quick correction means. It's usually not good. And learn that from the past, but trying to overlay charts to predict when this is going to change, it really isn't going to do us that much good. So now that we have all that knowledge of the past with us, how can we be proactive today? Based on what we know, is now a good time to lock a 30-year rate? Absolutely not. Why would you do that? Anytime I do a loan for anybody now, so at ARM, I didn't really talk about this in the beginning, but what I do for ARM, I'm located in Georgia. If y'all haven't picked it up on the accent yet, I'm not up in Wisconsin or Minnesota, where I know a lot of you are. I'm in Georgia, and but I serve all of ARM as it relates to the real estate loans. So I do loans all across the country. And with that, I have people come to me with different issues. They have different types of businesses. They have, I do dairy loans. I do row crop loans. I do agribusiness loans, cotton gins, sweet potatoes, houses, all the things across the country. But no matter what it is, no matter what you're locking a rate on, I'm going to tell you, if you get a loan approved with me and we get ready to rate lock, I don't even want to offer you the 30-year rate. I will give it to you and I will tell it to you. And if you try to tell me you want it, I'm going to tell you why you don't need it. But if you still want it, I will let you have it. That's kind of how the conversation goes. Because when you lock a 30-year rate, at 3.25, if you lock a 30-year rate, good for you. That's awesome. I hope you still have it. I hope you don't have to touch it. That was a great move. But a 30-year rate right now, to pay that much for it, knowing historically, looking back, that we're not going to stay up here forever, that we're going to eventually start to come back down. We don't know when, but is it going to be within the next 30 years? We just looked at from the 80s till now. How many movements did we have? There was a lot of movement. I was born in the 80s. So, those three charts is kind of across my lifetime here. So over my lifetime, how many movements of rates has there been? A lot. So if you were to lock for 30 years, you're to say, I'm not going to move that loan for 30 years. I don't think you would not move that loan for 30 years. You may need to transition to somebody else in the family. You may build up a bunch of equity and you want to use it to purchase another piece of property. You may want to get some cash out because you need to pay off some other expenses or cash out to expand your operation. So why would you pay the additional if you know that you're going to move it within 30 years, especially at today's rates? If it's 3.25, lock it and hope we don't have to touch it. But in 8% plus territory, I'm not big on locking that for 30 years, knowing that you're not going to leave it. You can tell me you're going to leave it there for 30 years, and I'm going to tell you, okay, you're lying. We can agree to disagree on that. So if we're facing more rate hikes, should we take risk off the table? And two things. So I have on here and fix our line of credit rate. that was more of a conversation toward the beginning of the year, but it's still a conversation going into next year. But also, if there's something that you want to go ahead and purchase, I would say go ahead and work on that now. Whether if you have a purchase that you're looking at, say you have a landlord that's saying, hey, I want to get out by the end of the year, and they came to you and said, hey, look, we need to get this rolling. I would say go ahead and do that, because the way it's looking, we're probably going to look at 1 or 2 more rate hikes is what people think. I do not know what's going to happen, but that's what we're looking at. You might as well go ahead and take the interest rate risk off the table and lock it in. And a line of credit rate. Historically, lines of credit have been tied to variable rates. They're like prime plus 100, prime plus a half. Depending on what part of the country you're in, how competitive the bank is, the size of your line, a lot of things weigh onto that. But, last year, when we had all the interest rate hikes at one time, and the people that, had a variable rate at the beginning of the year and made their budget based on that, that interest expense, they blew out that line item very quickly with all the rate hikes that happened. So it's not out of bounds to ask your banker about a fixed rate on your line of credit to take that risk off the table, because chances, the rate may be a little bit higher than what it is to have a floating rate. But if you get to avoid 2, possibly 3 rate hikes, it's worth it. And you also have the peace of mind of knowing you're not going to blow out your interest rate expense on your budget, and you can keep true to what your budget is. You know what that number is going to be. You don't have to guess about it. So how much will that cost? Going ahead and doing it now is going to save you money if you purchase land now. So go ahead and purchase it, get moving, get the rate locked ahead of the hikes that are coming. So that could save you. I don't think the next rate would be 50 basis points. It probably another, 25 basis points. 25 basis points on a large loan though. We're talking about farmers and the amount of money that they borrow. My average size loan that across my portfolio, of course I do smaller ones, my average size loan is $2 million. 0.25% on $2 million is a decent amount of money. Of course, it's nothing to sneeze at. Then for your line of credit, if that's something that you can take a look at now, you may just say, call your banker and say, hey, I've already got my line of credit. It's at a variable rate. Can we go ahead and just lock it now until it matures? And just see if they'll do that for you. They can quote you a rate. That may save you 50, 75 basis points between now and the time that your line of credit matures. So next, preserve cash. I'm just going to go ahead and throw all these up here. The reason I say preserve cash is when we see the times that we're in now where rates are on a trajectory upward and input costs as well for farm operations and commodity prices are going upwards. Your first line of defense against commodity price volatility, milk price volatility, and input price volatility is cash. Cash is what can fill in those gaps for you. You don't have to go to the bank and hope that you can get a loan, hope that you can get it closed in time, rob Peter to pay Paul to solve any issues that you have come up in your operation. So preserve the cash that you have because it can save you in these times. Borrowing restrictions and heightened levels of credit scrutiny have followed past cycles. Think back to the 2008 financial crisis. If you were farming back then, I am sure, 100% sure, that in years following 2008, your line of credit renewal, any type of loan that you wanted to purchase land, any type of loan request that you had came with additional scrutiny. It wasn't just the days of handshake lending, they're ended after the 2008 financial crisis, but additional borrowing restrictions. So it may be if you're on a borrowing base for your line of credit, those can tighten up because it's the interest rate cost associated with you paying back that line had increased. So the amount of money that your banker wants to give you or the calculation associated with how much they can give you could be lessened. So it's important to think about your cash reserves as it relates to that, and then manage and keep in mind the borrowing restrictions in your borrowing base as it relates to your interest rate. Borrow what you can and save some cash. And I'm not telling you to go out and borrow every penny and, get overly debt crazy. But, you know, if you were presented with an opportunity to purchase some land and you have this piece of land over here that you have 60% equity in, and then you also have $500,000 cash reserves there, it may be worth it to not use all of your cash for down payment and use some equity in that other piece of property to be able to save some cash to fill in gaps if rates continue to increase, if input prices continue to increase, if commodity prices dip, if milk prices dip, to have that in there. Is there the chance that if you take the equity out of that piece that you have 60% equity in, will you have to give up that 3.25% rate and go up in rate? Yes, there is. But if there's an opportunity cost, it's hard to calculate that with you not purchasing that piece. See, that's something you have to weigh out what works best for your operation moving forward. So we really talked about how much will that cost. I mean, you can't really calculate an opportunity cost, but you know, some folks, I'll talk through it with them, and it's, you know, I don't have to have that piece of property. It would have been nice to have, but then some folks know this is a piece of property. I've rented this for 20 years. If I don't buy it, he's going to sell it to someone else. You know, it's the best one logistically. It's my best producing farm. I already own the pivots on it. All this stuff. I have to buy this piece of property. Then that's when, you know, okay, it makes sense. Let's run the numbers. You'll have to give up your rate, but you'll get the credit of the rent expense against it. Let's see what the interest rate will be with that, and then how much cash would you get to save, and what would you use the cash for? So that's the point with the preserved cash. I think that's one of the most important things to think about here. So now I think it's really important to run some analysis on your operation, and that's kind of what I was just talking about. Is if you have a scenario where you want to purchase something, if you want to purchase something, if you are going to take on additional property that you're going to rent and you're going to need additional borrowing needs, run some analysis. Know how much you need to borrow so you don't overpay on fees. You know, ARM, I do the real estate lending side of ARM. But we also are not, well, actually, I shouldn't say we also do lines of credit. ARM is known for lines of credit. That's ARM's core business. But, you know, some folks show up, and whether it be to ARM or the bank I used to work for, and historically, I've always borrowed $2 million on a line of credit. But say they've operated some of the cash the past 2 years, they've only borrowed $1 million against it. And there was a $1 million outstanding. You know, they didn't even use the whole line. Well, the way fees work, fees are front loaded onto lines of credit. So if you're being charged 1%, you're paying 1% on the full loan amount, not just on what you draw. So if you know up front how much you need to borrow, so you only need the 1 million, say it's nice to have the additional, but do you need $1 million additional or that much additional? Try to run the numbers and know how much you need to borrow so you don't overpay on those fees. Save those fees. Run a sensitivity analysis. Your banker's going to be running one. You might as well, so you'll understand what they're talking about. Or they're running it, not telling you. You might as well ask them about it. Be like, hey, let me see the one you ran. And all that is at what point can you not afford at what point does interest rate impact your debt load enough that you can no longer make your payment or not make it comfortably? So if your debt service coverage you looking at is 1.25, which means you have 25% extra cash after covering debts 1-to-1. If rate hikes go up another 1% and you have a variable rate on your line of credit, how much does that 1% impact you? Does it take your debt service coverage down to 1.15 and you lose 10% that you were going to be able to keep there? At what point does that debt service coverage get too low, or at what point does it hit break even? And you can do this for thinking about land. Like if you have loans that are about to balloon, I'll also mention that if you purchase land and you're on a 3-year or 5-year balloon note that is going to come due this year, next year, or the next, go ahead and take a look at renewing those now. In a rate sensitivity analysis, because if they're at 3.25 and you have to do them at 8.5, that's a big difference in payment. And go ahead and see what the difference is going to be. And if it makes sense to maybe re-extend your AM or do something different to be sure that you're properly structured moving forward if you have to renew your real estate loans, and also if you have to renew your line of credit at a higher rate. The main thing is don't underestimate interest costs in your budget. If you don't have a fixed rate on your line of credit, and if you have a loan that's up for renewal that this year that you've not renewed yet, go ahead, be proactive about those things and figure out, can I fix my rate on my line of credit? If not, what do I think it could go to? Use the higher interest rate cost. Okay, I think there'll be 3 more hikes. So I'm going to estimate my interest at the highest possible rate for my line of credit. Go ahead and think about your payment coming due this year with the additional interest rate being built into it, so that you know what your interest costs are going to be. And you can overshoot it. I'd rather be pleasantly surprised than disappointed any day as it relates to that. So with that, I'm going to end on a little funny note here. And then I'll have about 10 minutes left for questions. But someone pointed this out to me. Well, we were talking about it. I don't really don't know how I figured it out, but there was an economist that foresaw this back in 1981, everything that's going on. The preacher man said it was the end of time. I don't know if y'all remember, but at the beginning of this year, the Mississippi River was going dry. Interest is up and the stock market's down, and you only get mugged if you go downtown. And that economist was Hank Williams Jr. And his advice to survive was a shotgun, a rifle, and a 4-wheel drive. So if you want to take any of the advice that I gave you, you can listen to Hank, and that is what he says, and you'll be just fine. Don't worry about your interest costs. Just have a shotgun, a rifle, and a 4-wheel drive. And that is the end of my presentation, and I'm more than happy to answer any questions that anyone may have out there.
Yeah, thank you, Ashley. That was great. So like she said, this is a great time to ask questions one-on-one with an expert. So please feel free to use the chat or unmute yourself if you can.
So I have a question, if I can jump in here. So Ashley, we bought a property in 2021 and locked in a 5-year rate that, of course, at that, was really good. How do you plan moving forward, knowing that any rate that we're going to continue on this is like several $1 million? How do you plan now your interest rate cost? We can't, I think what I heard you just saying that, you got to be realistic about your interest rates.
Yes, and you said you did it in 2021, so it balloons in 2026?
Correct, yes.
Okay, well, I would say 2026, I wouldn't try to move that right now. I would go ahead and start looking towards the end of next year. I would probably start thinking about that, but I wouldn't do anything with your cash flow right now. What I was referencing, and I'm glad you asked that question, so for anyone else who may have taking it the wrong way, I can't talk, is for anything that's coming due this year. So if your payment is going to change this year, so say something was coming up to balloon in July, because a lot of loans have semi-annual payments that are due like January, July, or June, December. So anything that was going to come up, say it was due in June and you haven't signed the paperwork yet, when you're making your budget at the beginning of the year, if you know that you have a loan that's going to balloon that year, go ahead and increase that payment. Don't leave the payment at what you know it is. Go ahead and increase it because you know the payment's going to increase that year. So you heading into 2025, if you know the payment's going to change in 2026, I would then take a look at it in 2025, looking to go forward.
Thank you.
Okay, so we do have a question in the chat, and Sarah is asking, kind of off the wall question here, but as someone who just finished grad school and has recently began her career, what are some do's and don'ts when it comes to finances? Great question.
Finances, you're talking, can we be a little more specific, Sarah, if you'll speak up? Are you talking about as it relates to farm finances? Finances?
No, just personal.
I would say the main things, because what I'm going to relate this back to is credit reports. So I have a lot of products I work with that are credit score based. They're scorecard programs. We look at your debt to asset ratio. We look at your current ratio, loan to value, and your credit score is how we make the determination. And looking at credit reports and things that impact credit reports, I do a lot of unpaid for credit counseling, I guess you'd say, but taking a look at things that people don't think impact their score or can impact them financially. A lot of it is related to credit cards. Some people need, I was talking actually to a gentleman yesterday who had really used cash his whole life. Would it be great to do that? All they had was, a car and a truck. That's all they had financed. It really just started using, he's 37, only started using credit like 2 years ago to purchase things. And I'm like, but his credit score wasn't that great because he didn't have any credit history. So it's important to get credit history. Credit cards are good to establish credit history, and it's good to have a credit card open that has an available amount on it, but you never want to use over 30% of your over available credit amount. Anytime you get over 30%, that's when they start knocking down your credit score hard. Always pay off your credit cards every month, but if there's something that has to stay on there, I know some farmers like to use credit cards to get points sometimes or build up cash back. But you still need to pay those off in a timely manner, or have other credit cards that are open so that your amount overall revolving balance is higher, so that not balance is higher, but your available credit is higher, so that your balance in relation to that isn't so high, so it impacts your credit score. So I would say for finances, my tips would be don't get in trouble with credit cards, pay attention to and understand what impacts your credit report. And really just really stay on top of that. And make decisions. Don't make snap decisions. That's another one that I get young farmers for a lot. It's, a lot of farmers I want to grow as fast as I can, and too big, too fast is the end of way too many farmers, but it also can be the end of people personally. If they, just start making a little bit more money, and then I want to buy a new house, I want to buy a new car, I want to buy side by side. I have a credit card, I want to go buy a new Louis Vuitton, treat myself because I had a bad day, things like that. So too big, too fast is one of the biggest things that hurts everyone, no matter in the business sense or personal sense.
Awesome. Thank you so much.
Mm-hmm.
All right, what other questions does anyone have for Ashley?
Well, I'm going to jump up with one more. The charts and the information that you had earlier, is there a global impact that we're seing more now, or is this basically US data? I wonder if you could just speak to the global component.
Are you asking if the data used in the charts
I think is US data.
Yes, that's just prime rate. That's US prime rate is what those were. That's what prime rate has been historically, is right. What the charts were. The global impact, I think the global impact is seen more so on the current chart, the 2017 to now, more so than any other chart. The 2000s were self-inflicted wounds by the US with the financial crisis and .com bubble, of course. But the COVID was something that was not a self-inflicted wound. That was a global thing. And we're still having global supply issues. We're still having issues with relations with other countries as it relates to trade, coming from the Trump administration into the current administration, issues on both. And I think that weighs into the inflationary issue that these interest rates are trying to calm down. So I don't know if that answers your question for the global aspect of it, but this most recent chart is the one that would have that I think has the biggest global impacts on it and has the most global implications, more so than something that would be considered a self-inflicted wound by the US. It's something that we can't, a lot of it, some of it is issues we can't help. as it relates to COVID, but some of it is issues we can help with how we responded to COVID in some instances, but also how we have issued trade agreements with other countries as well.
Yeah, I mean, that makes a lot of sense. And I think you're absolutely spot on. I'm wondering though, like, you know, you see the rate of inflation we're experiencing now. Would you, are other countries also experiencing high rates of inflation now too? Or is it mostly what we're seeing here in the US?
I think it's a little more rampant in the US as it relates to other countries. There is, inflation in Europe. A lot of European countries are experiencing inflation, but it is a little more high here than it is others. And I think that once again ties back to the self-inflicted part of the chart with the trade part of it, because logistical issues and the supply and demand is what led into the COVID bubble and everything costing more than it should. But other countries don't have as many issues with that because they don't have as many issues with trade as we do, because it's one thing to not be able to get the product because logistically it can't get here. But it's another thing to not be able to get the product because there's a bunch of tariffs on it. We don't have a good trade agreement with these people. We've made these people mad. Or we have to get it from somewhere else and all of that type stuff. So we kind of have both of those issues where some countries are just still, the tail end wrapping up, getting supply and demand back in check from COVID.
Okay. Thank you.
We do have 2 minutes left. If anybody else has any questions, you can feel free to unmute yourself or again, use the chat. Ashley, are you seeing that the amount of loans people are applying for are down because of interest rates at your business?
That's a good question. We still have a good level of business this year. But I will say it has become a lot more competitive, and that may seem counterintuitive because you would think, it's a competitive market when you're at 3.25. But right now when everybody offers 3.25, and like I said, that was the norm, and people were getting spoiled by only having 3.25. When people are like, okay, well, this guy's nicer. I really like dealing with Ashley better. I'll just, do the loan with her because I like working with her. Well, now there's, real life implications with it when you're talking about interest rates, and the interest rates make a real impact. If you're renewing a loan that was at 3.25, that's going to renew somewhere, at 7.5, and someone else can offer you 7.2 and I'm at 7.6 or vice versa, something other than, I like working with Ashley or I like working with Joe or whoever it is will come into play. At that point, people are being a little more picky now because, interest rates are a real issue. Well, I shouldn't say issue, but they are a real concern for a lot of people when they see it blow out on their line item. So we are getting probably the same level of requests, but we are seeing a lot more competition. So some folks will show up and then call and say, we appreciate you looking at it, but we went with such and such instead because of rate or whatever it may be. So.
Thank you. All right, last chance. Anybody have any other questions? Okay, I'm not seeing anyone unmute, so I will go ahead and close this out. Ashley, thank you so much for taking the time to be here and share this information, especially just after having your first little one. So that's very special, and we thank you for sharing your time with us. And I also want to thank Ag Resource Management for sponsoring today's webinar and supporting this webinar, and then also to Zoetis for being our Enhance webinar host. And so everyone, you can expect the recording of this webinar in your inbox within 7 days. And thank you for joining us. I hope you have a great rest of your week.
Thank you.